Hello and welcome to the February edition of PMW's Financial Market Commentary. When I reported to you last time, I mentioned that the investment outlook actually appeared more favourable than priced into financial markets at the year end. And I'm pleased now to report that investor sentiment has indeed improved, and there are two key factors that have been driving this. The key one is monetary policy emanating from the US Federal Reserve. As a consequence of the volatility that we've seen in financial markets, the language coming from the US Federal Reserve in terms of speeches and the minutes from their various monetary policy meetings is soothing financial markets by indicating that maybe after all interest rates won't increase as much as feared, perhaps not at all in 2019. And perhaps more significantly, the program of quantitative tightening, that reversing of the quantitative easing process that was introduced in the aftermath of the financial crisis, that quantitative tightening will end in 2019. So why is it important? Why is it good for financial markets? Well, higher interest rates means a higher cost of borrowing for companies, and that reduces profitability, and that therefore is a downward pressure on share prices. And secondly, the quantitative tightening process reduces liquidity in key financial sectors, encouraging volatility. So one source of very good news. Moving to the second factor, it's all about that trade war between the US and China. Again, we've seen a softening in the rhetoric from both sides, and that's encouraging because the unilateral tariffs imposed by both sides are really starting to bite now and having an impact on global trade. And economists are predicting as a consequence of that that the global economy will begin to slow. So a pathway to a resolution, an end to hostilities is very positive for financial markets. A consequence of this improvement in investor sentiment is that financial markets have recovered much of the loss that they suffered in October and December 2018. So we've got off to an encouraging start. And in fact, I'm pleased to report that a typical PMW portfolio has generated a return of something like 5% so far this year. Now, we're often asked when we review client portfolios, what methodology we use. In fact, we use lots of different processes and methods to construct portfolios. One of the key things for us is diversification. We don't like to see anything more than, let's say, 1% of a portfolio invested in any single company. And the reason for that is that if a company were to fail, any money invested in it would be lost forever. And therefore, it should be avoided if at all possible. One of the things we also look at is diversification benefit, which is on the same theme but slightly different. So one of the important things that we do when we build a portfolio is to engineer in plenty of negative correlation. In other words, we're choosing investments that will behave differently for a given set of circumstances. As a consequence, when some things rise in value, other things will fall, and vice versa, so that the overall portfolio value is smoothed. It significantly reduces volatility. That's very important for most of our clients. Our clients will remember that during the course of 2018, we commenced the evolution of the approach that we use to allocate equity investment. Historically, we've allocated money strictly on a geographical basis. So we look at the world, decide where is an attractive place to invest, and allocate money accordingly. And that theme still retains some relevance, but of course the world is getting smaller, and it is becoming more relevant to look at sectors of investment that have a global theme. So for example, rather than look at the UK equity market as an investment destination, one might look at global energy companies or global agriculture businesses or healthcare. And to commence that evolution, we allocated 10% to what we call global thematic funds. We chose the Fundsmith Equity Fund, which is a fund that has a no-nonsense approach to investment management. It focuses on a relatively small number, in fact 27 at the moment, very large companies, and the investment manager, a gentleman called Terry Smith, looks for companies that have consistent and viable, longer-term business model and very good financials. Now, typically these are big businesses that he buys into. They have a market capitalization on average of something like $100 billion. But so far we've been delighted with the returns that have been achieved. And in fact, if we look at 2018, which was a tough year for investment, that fund generated 8% more as a return than a typical global equity fund. When we're thinking about investment, we always have plenty of ideas on our radar. One of the key themes that we're wrestling with at the moment is at what point do we start to reallocate money back to the UK? At the moment, the UK equity market is in the doldrums relative to its peers, particularly in the smaller and medium-sized company sector, where we think companies are quite significantly undervalued for obvious reasons. At some point, it'll be time to return focus to the UK in order to benefit from what we see will be quite a strong recovery in the medium term. PMW clients have been well served by the approach that we've taken to investment in UK equities. In the run-up to the EU referendum, we cut our exposure to UK equity funds from 52% all the way down to 43%. And in fact, in the aftermath of the referendum, as a result of the political uncertainty that has prevailed, we've reduced further and now stand at 33%. In due course, I'm sure that's going to rise, but I don't think the time is right yet. So I hope that this update has been helpful. We're just trying to keep you up to date with our thoughts and what's happening in the wider world, and I look forward to talking to you next time. Thank you.